There we go. The presentation is about an hour long, about 45, 50 minutes of content, and then questions. Once again, though, I would love for the questions to keep coming throughout the presentation. If I'm going to cover it during the presentation, I will let you know, and we'll eventually get to it at some point. So, how did this presentation come about? Well, it started off because this group's purpose is really large multifamily. So a lot of the people that come here, there are students of Dave Lindahl in here. For example, Neer's a student, Lucy's a student. John Mark and I both have already been to training with Dave Lindahl. And so that's really all large multifamily, 50 units, 100 units, 500 units. But what we noticed is a lot of people that come to this group, they really don't want to invest in or buy large multifamily. They're more interested in duplexes, triplexes, quadplexes, anything but a single family. There's lots of great single family groups in the Bay Area. This is not the right place if you're interested in single family. And they were interested in small multifamily. And then all of them, the feedback consistently was the Bay Area for small multifamily, it's very difficult. Like Leslie's been lucky in that she's been able to buy in places like Richmond. But if today she was buying, they wouldn't cash flow easily. Right? So they cash flowed a while back. Now it's a little more challenging. So people wanted an option outside the Bay Area. So we get this question very often, what are good cities if we want to buy small multifamily, if you don't want to buy a big one, what are good cities and what are the pros and cons of those cities? So this presentation has been put together really, I've pulled together hundreds of answers that I've given people over the last 2 or 3 years and tried to put them all into one presentation. If you guys like it, we'll do another one where we'll pick another 3 cities. So let's get started. So 3 cities that I picked the first time around. I hope you like the cool Fight Club graphic there. So one of my favorite movies, by the way, awesome movie. If you haven't watched it, completely watch that movie. It's amazing. Yeah, okay, that's fine. So the 3 cities that I picked, Chicago, Dallas, and Kansas. Why did I pick these 3? Well, I've invested in them. So since I've made investments there, I have learned both the good way and the hard way about these cities and about their challenges and their benefits. So, all right, let's get started. Click, there we go. First, an important disclaimer. We're not investment advisors. This webinar is provided for education services only. I'm sorry this is going to irritate you, but I am going to read it. All investments involve different degrees of risk. Be aware of your risk tolerance and financial situation of all time. Furthermore, you should read any and all prospectuses carefully before making an investment. Any and all information should be researched prior to investing any money with us or, for that matter, anyone else. You're free at all time to accept or reject all investment recommendations made by us. I don't know what that word is. We offer are subject to market risk and may result in the loss of your investment. As you know, a recommendation which you're free to accept or reject is not a guarantee for the successful performance of an investment, and we are expressly prohibited from guaranteeing against losses arising from market conditions. Do not invest your money on our recommendation alone. Hopefully this made sense. It's not boilerplate. This is supposed to resonate with you. Hopefully it does. All right, here's our goal for today. So first I'm going to give you a quick introduction to myself. Then we're going to talk about who this webinar is really intended for, who's the target audience, then why these cities, and I'll give you a little bit about my background with these cities so you kind of know what sort of questions I can answer and what questions I won't be able to answer. Then I'll tell you how to select cities for investment, or I should say how I select cities for investment. Hopefully you can give me some other tips and I can add to my list. Then I'm going to talk about Chicago, followed by Dallas, and then we're going to talk about Kansas City. And then we're going to get to the most interesting part, the actual Fight Club, where we will compare these cities on 17 different parameters. And then we're going to talk about suggested next steps for you if you're interested. A lot of people will say, okay, this was great learning, but I don't necessarily want to run out and buy something in Dallas or Chicago. But then there's others who are like, okay, I want to go buy something in Dallas, or I want to go buy something in KC. Well, I'll give you next steps at the end of how you should go about doing that. And we'll take questions at the end, but to be honest, hopefully if you have questions, we can take them as we go. So about me, together with my partner, John Mark there, I buy and manage multifamily complexes nationwide. Just so you guys know, I am biased towards large multifamily, and I'll say it up front. that's what we do. We buy large multifamilies, but I know that there's lots of people that are interested in small ones, hence this presentation. I've invested in both small and large multifamily, and actually today, in about 5 minutes, you're going to see a portion of my portfolio, both for small multifamily and large multifamily, because to be honest, 80% of my investments happen to be, well, maybe 70% happen to be in these 3 cities. I currently own single-family homes, duplexes, triplexes, 1 quadplex, and John Mark and I together are invested in over 2,000 multifamily units, both as investors and syndicators, so a mix of those. Our properties are in these states: California, Texas, Kansas, South Carolina, Oklahoma, Illinois. Am I missing anything? That I had 6 states, John Mark. We're good? Okay, yeah, we're good. We have 6 states. So looking to add more very shortly. All right, so who's this webinar really for? There's 2 audiences that are the core audiences for this webinar. Those that are looking to invest their money for cash flow or appreciation, or both, hopefully both. And then the second audience, those that are looking to do multifamily real estate deals. They're looking to either do a buy and hold or buy and flip by raising money from other people, right? So they want to raise money from other investors, and they want to basically do this as using arbitrage. Yep. So, oh, have a balloon. I have a question from my online audience. Let's answer that question. So the question is from Laurent, and Laurent says, do you have an intimate knowledge of these cities? Have you lived in any of them? The answer is no, I've never lived in any of the cities. I've invested in all 3 of them, so I have an understanding of investment in these cities, but I'm definitely not a Dallas boy or a Chicagoan. So no, the answer is no. So why did I select these cities for Fight Club? Besides the fact that I've invested in them, there were other reasons. Number one, these 3 are cited as 3 of the top cities for turnkey real estate. So is there anyone in the room that's not familiar with what turnkey real estate means? Anyone? Everyone know what turnkey real estate is? So turnkey real estate is where someone buys and rehabs units and brings them up to a nearly new level and then sells them to investors. So these 3 cities are probably in the top 5 in terms of turnkey, with Chicago probably being the first in terms of just sheer volume. I would say Dallas is number 1, but then followed by Chicago. Indianapolis and Memphis are others, also Trenton, New Jersey, but I don't know those cities really well, so I decided to pick these 3. Another reason was all of these cities have multifamily inventory, which is kind of rare because a lot of cities only have single family inventory. Chicago and Dallas actually have very significant amounts of multifamily inventory, duplexes, triplexes, quadplexes. There's plenty. You can buy them on the open market. Kansas is a little harder to find them listed, but they're there. Trust me, they're there. Also, and this one is very important for people that are very cash flow driven, 2 of these 3 cities actually have distressed inventory. Distressed inventory is an opportunity for those who have lots of time. You can buy properties for very cheap prices. I'll show you one of mine that's distressed, and it was a fantastic deal. I made a lot of money. I also gained a lot of gray hair. So those things kind of go together. You there? You see all this stuff here? How do you know that I'm not using color?
Oh, I could have made a mistake.
All right, so what size of multifamily is this presentation for? As I mentioned, it's really impossible to do a Fight Club for both large and small at the same time. The cities wouldn't match. So this particular presentation on special requests from lots and lots of people over the months is specifically for small multifamily. And here's the reasons why you can never do a Fight Club simultaneously for small and large. Inventory, foreclosure rate, cap rate, these vary between small and large, right? So this one is the smaller multifamily units. Now, having said that, I want to point out this last part here. Many of the principles and methods discussed will apply all the way up to 500 units. And we can talk about that offline maybe at the end of the presentation. There's a bunch of stuff that still works. For example, at this point, John Mark and I are buying a 237 unit with Holly's help and with the help of other people in Chicago. Right, so at this point, Chicago worked for large multifamily as well, even though it's a contender for small multifamily as well. But be careful not to ask me a lot of questions about large multifamily. I won't be able to answer them during this presentation. All right, so Dallas, I've invested in one of John Mark's syndications, another one that's a 384 unit. It's a Class B, a retail center, 2 duplexes in Dallas that I purchased, but at the very last minute the deal fell apart because they didn't appraise. Someone here knows about appraisal pain. Yes, looking at Charles. So, so Chicago, I currently own 8 triplexes, which are composed of 22 units by myself, and I also oversee duplexes for my family. 4 other investors in my California friend circle, I'm again looking at Charles, have also invested in Chicago with me. And then, as I mentioned, John Mark and I are buying a $12 million, 237 unit multifamily. And the multifamily actually is very, very close to my triplexes. In fact, I have a triplex 300 yards away from the 237 unit that we're buying. And that's the one that Charles and I are working on. So Kansas City, I am currently invested in a 278 unit, which is a multifamily. It's in Kansas City, Missouri. Please note there are 2 Kansas Cities. Today, for the purposes of today's presentation, we are only talking KC-Mo. Not Kansas City, Kansas, but Kansas City, Missouri. And I also occasionally, not every month, but occasionally host a Kansas Rehab mastermind group at my home, because that was central for all the people that are part of that mastermind group. I was expecting one of them, Joe Torrey, to be here today, but apparently he couldn't make it. So those guys talk about this stuff, and they're doing flips in Kansas all the time, so I've kind of absorbed that stuff, even though I haven't done a flip in Kansas yet. All right, so now I'm going to talk about how I select a metro for investment. I'm very sure that this is an incomplete method. It's developed over time, but I think that some of the fundamentals here are very strong. Now, I wish that I could actually give you examples for all 3 of the cities, and though I know the examples, I couldn't possibly squish that into an hour. So I'm only going to give you examples for Chicago. Please note that doesn't make Chicago the best. That's going to have, you're going to see the results in Fight Club, right? I just happen to have Chicago details, and I can only squish one city in. So the examples I'm going to give you are all Chicago examples. All right, so here's how we look at metro research. So we look at jobs. Is the metro adding jobs, and is it adding quality jobs? Note that a tech job is considered to be equivalent to 2.5 regular jobs. Why? Because they make 2.5 times the money, right? And tech jobs tend to inflate rents. So nobody knows that better than Bay Area residents, right? You see what's happening in San Francisco and Oakland? Oakland had 22% rent increases. It's almost entirely driven by San Francisco's tech economy that's driving up rents in Oakland. So you look for jobs, but then you also look for tech jobs. So in 2013, Chicago was rated number 3 in the country for the percentage of tech job gain. I don't know what has happened in 2015, but from what I hear, things have gone better. So it didn't have a very large number of jobs. It wasn't anywhere as close to the San Francisco Bay Area or to Dallas, but it was gaining them at a very good clip. Rent growth trends. Is rent growth robust? So we look at both a past, rent growth, so we look at the last 2 years, and then we look at the future forecast. Then we look at supply and demand. What's coming onto the market, and how does that compare to the jobs? This is very important. The total new supply needs to be matched to the jobs. By themselves, neither one of these matter. Supply doesn't matter, jobs don't matter. Supply versus jobs matter a great deal, and I'm about to give you an example. Sales trends, right? So our price is going to increase as inventory tightens. And what I'm going to do is I'm going to show you 2 different sales trends. I'll show you the Chicago projections on the 1st of January in 2015. Then I'm going to show you the Chicago actuals as of November 1st. So you can see what the actual versus projection was there. And then cap rates, right? Will the property cash flow well? The best markets in the United States really suck for cash flow. So what are really the best markets in the US? San Francisco, some portions of New York, not the whole city, Denver, Seattle, Portland. These are awesome. These are great markets. If you can invest in them and can afford to invest in them, don't invest in Chicago, don't invest in Dallas, invest there, but be prepared to have no cash flow. You're investing for a very long time and you might come out on top, but you're definitely not going to do it with any significant amount of cash flow. Portland, maybe you might get 6%, but in most of the other places, you're going to make almost nothing, right? But those are really the best metros for growth. So keep in mind that when investing with cash flow in mind, you're pretty much knocking out the top 1/3 of the United States. Live with that if you want cash. All right, so I showed you those numbers, right? I showed you the tiles. Now I'm going to show you examples. So if you look at jobs, this is Chicago, and this is the very beginning of 2015. So this is Marcus and Millichap. I trust them the most because they do the most amount of research. Local payrolls expected to rise 1.3% in 2015 with the addition of 60,000 jobs. So Chicago essentially was on track to produce 60,000 jobs. Last year, they actually had a little bit more, I think. No, they had a little bit less, maybe 55,000. So is that a good number? The answer is there is no yes, no answer until you compare it to supply, right? So this is okay. 1% job growth is okay for a major metro. It's not great for a major metro. That's an okay growth. Now, you might say, well, if they have 1% job growth, how will they have 2% rent growth? The answer is if they have no job growth, they'll have 2% rent growth because 2% rent growth comes from inflation. Got it? Inflation in the US roughly is 2% gross. So the 2% comes just from inflation. Anything above 2% comes from job growth. Does that make sense? So I'll tell you in 2 slides whether this 50 or 55,000 number is good or bad. Effective rent rates. So once again, this is the beginning of the year, and I'm about to show you what actually happened here. It was completely different from what this slide is showing. Owners are, so what this is really saying is rents are expected to tick up 3.3%. Are you guys having trouble seeing it? Should I turn off one of the lights? You guys can all see, right? Okay. So rents are expected to tick up 3% compared with last year's pace of 3.5%. So is that good or is that bad? 3.3, 3.5? Is that good? Good, yes. Those are great numbers. Anytime your rent growth goes over 2%, you're having a really good year in multifamily. Okay? Especially if it's large multifamily because you get a double benefit. You get the rents and then you get the value increase. When you're doing duplexes, triplexes, quadplexes, you get the rent. You do not get the value increases because duplexes, triplexes, and quadplexes are not measured by rent, they're measured by comps, right? So now let's look at supply and demand. This is where the job number becomes important, right? So supply and demand for Chicago shows 65,000 apartments will be delivered, okay? Which is a roughly 1% increase in inventory. Last year they had 4,500 units that were brought online. Now, here's where your supply-demand mismatch is in there. How many jobs did Chicago produce in that slide? 60,000, right? Now it was projected to produce 60,000. The actual number based on the new Marcus and Millichap presentation is 50, but let's use 60 because it's easier for me to do the math. 60,000 jobs equals how many households? 20,000. 1 in 3. 3 people live in a household, right? So essentially 20,000 new households are needed. If you only produce 6,500 apartments, are you producing enough? No, you're not. A supply-demand imbalance will be created, correct? Now, if there's a supply-demand imbalance, how much do you expect rents to go up by? If standard rent increase for inflation is 2%, how much do you expect that to go up because of a supply and demand imbalance? 2.5, 3, 3.5? Yeah, maybe those numbers? All right, here's what the newest projection is for Chicago as of 3 weeks ago. So now at this point, okay, I'll take that question in a second. So here's what really happened, and this is as of November 1st. Notice that they are now projecting, where did I go? Okay, I need to scroll a little bit. They are now projecting effective rents will surge 6% for 2015. 6%. That's what supply-demand imbalance does. Unfortunately, it's not linear. A small supply-demand imbalance creates a large increase in rent. which is odd. Now, keep in mind, 6% was not south side. So the south side actually was 3.3%, right? Because where will they surge the most? They will always surge the most in downtown, right? So downtown Chicago was 12%, somewhere in that range, where what's the south side was about 3%, because that's the least sexy area.
So I think you made an assumption there that the vacancies, the number of people coming in maps to apartments, but isn't it a lot of them will be commuters coming from single family homes and other places outside the metro, right?
No, the answer is, if a metro gains 50,000 jobs, will all the jobs be from people outside the metro?
Or single families or others, was the question. Was it all?
I wouldn't say that. I think the way we look at it in most cases is, for an area that has vacancy this low, look at the vacancy numbers, right? So vacancy in Chicago is already extremely low. Look at this, 3.6%. So it's not like the city had a lot to give, right? And now 50,000 new, jobs have appeared. So there's 20,000 families that have come in and they need apartments, right? Well, these 20,000, some portion of them, I'll grant you, were living in the city already. One more person, one more person came in, right? So just for the online folks, the question really was, weren't these people coming in from outside the city? The answer is some portion of them will come in from outside the city, but a vast majority of them are actually moving in. Cities that produce jobs, their population grows, and it grows almost exactly with the job growth. So a city that like Detroit that was losing population, it was also losing jobs at exactly the same rate for the last 25 years. So basically what's happening is the city is getting bigger. A bigger city needs more apartments. So you notice how much of a fluctuation there is, because a moment ago we saw the number at 3.3%. Now as of 3 weeks ago, they're projecting 6%. But within 6%, south side is 3%, and then portions of the north side are 9 or 10%, right? So there's a lot of fluctuation. So moral of the story is, when studying jobs, know which neighborhood is affected in which way. Every major city in the US has real estate newspapers and column, people that are writing columns, and most of this stuff is online. It takes less than 5 minutes for you to type in your city name followed by the word rent, and then in Google, click the news button. In 5 minutes, you'll find a breakdown of your area. I guarantee it. In fact, maybe I can just show you. So we'll go to, see if we can open.
Is anybody interested in having those instructions again? Will anybody use that? Yeah. So give them the instructions on how to find that.
Sure. So Chicago, actually, hang on. Let me open this one here. You guys just noticed, you saw my kid's favorite website. I don't know if any of you know what that website was. Google, there we go. So Chicago rents, and then click on news, and then here, right there, suburban rents keep climbing. Now I don't want to keep going into this because it'll take me a while, but in there is a graph, and it breaks up the city by neighborhood, right? You can find this for every city in the US. Really simple. Much simpler than you think it might be. All right, back to the presentation. I have a question. Let me take that one. Okay. Attendees here. Oh, that's just a hand that's raised, actually. It's not a question. Usually a question will look like a thought bubble. So let me go back. All right, so you notice here how supply and demand works together with inventory. Now, if vacancy was 10%, the correlation between jobs and supply and demand doesn't matter, because there's plenty of inventory, right? The new jobs that come in will just take on some of the inventory. But Chicago's inventory is ridiculously low. At the beginning of 2014, it was at 4.2%. It's now at, or beginning of 2015, it was 4.2%. Actually, no, they were projecting that as a number at the end of the year. Now they're projecting 3.6%. So the city really, doesn't have a lot to give. So at this point, when it starts getting job increases, the city is going to get hammered for rent, hence the 6% projection.
Hey, what is ridiculously low, just to make sure everyone knows, when you say 5% of
I'd say 5 is, it starts to get really low. At that point, people are just fighting over the place. Now again, it varies. South side, where our properties are, typically tends to be at more like 7. And 7 is considered low on the south side. It's low right now. So it again varies by area. And then sales trends, you see some of these numbers, right? Well, if I went back to the Marcus and Millichap thing, and I'm not going to do that because I'll run out of time for the presentation, you'll see even higher numbers. So now Marcus and Millichap is projecting that this 15 bar is going to be 175,000. Now, so you see these numbers right now, that 14 bar looks like it's maybe 145,000. They're now projecting, well, I think it's more like 165,000. So their 15 projections are very high. Now you might say, what does that number really mean? That number means that the average apartment unit is being sold for this much. But the problem, there's a huge, huge problem there. The problem is that the city skews everything. So the average price in the city is well over 500,000, and the city has had gained the most number of jobs. The downtown area has gained the most number of jobs, and they're tech jobs, right? So that tends to skew the numbers. So once again, you go back and research the city to see what the numbers are like in your area. So for example, the area that we're buying in, we're buying at $51,000 a unit, and the typical number in that area tends to be between 60, 65,000 per unit. So that's the typical price. So I shouldn't be hugely excited that I'm buying at 50,000. My units are not worth 140,000 just because this bar says they are, right? So look at the sales trend. Don't go into a city that doesn't have an upward curve. Please do not try to be the first to a city. You will suffer, I guarantee it. Most people cannot time a bottom. Most people that are very experienced cannot time a bottom. Wait for it to get off the bottom. Let the first 10 or 20% go by, then get into a city. So look at construction. Usually you want to see construction. Chicago has a lot of construction in downtown. You want to see those kinds of trends happening. Now, you might not see a lot of construction in the area that you're buying in. Why is that? Well, because typically if you're buying class B's and C's, and keep in mind, mostly if you're buying for cash flow, you're going to be buying B minuses and C pluses. Well, those areas actually tend not to have a lot of construction. That doesn't matter. What you want is for there to be a lot of Class A and Class B construction in a 10-mile radius from you, because eventually those will lift the value of what you're doing. So Chicago, for example, right now in the city, they're selling at $250,000 to $500,000 a door. So when we're sitting there at 50, we're going to start seeing an inflation effect over time. So suburbs, you want to see some Class Bs. These are mostly Class Bs being constructed, and that's good. But you want to see some demand in the suburbs. Now, the exact breakdown for Chicago was 3,300 units were in the city, 2,700 units in the suburbs. So they're leaning more towards the city, so you should be fairly close to the city. Our building's about 9.5 miles away from the loop. So that's fairly close. Look for enterprise development zones if you can find them. These are very, very easy. In fact, you can go to Google Pictures and say Chicago Enterprise Zone, and this picture will come up. If you want to do Dallas, do the same thing. Dallas Enterprise Zone, it'll come up. They're very easy. Try to stay close to development zones because the city is spending money in those areas, right? Always follow the city. They say don't fight the Fed. In the same way, don't fight the city development office. Look for crime. This is what I do. I look at spotcrime.com. There's really good areas and really bad areas in every city. For example, you might think that the graph at the bottom is Chicago. You might think that the graph at the top is San Francisco. But actually, you notice the 6 gunshots in the bottom one, right? There's 4 in a cluster and 2. You're looking at downtown San Francisco. And the one at the top is the building that we're buying. Looks a lot cleaner, right? I see 1 gunshot off to the side, nowhere close to where we're buying. We're buying right next to this cultural cluster near the lake. You notice there's actually more violence going on in certain parts of San Francisco. Now, I am guilty of having picked a more violent part of San Francisco, but I was just trying to get a point across. Not all of San Francisco is like this, obviously. So crime is very local, right? And it usually varies by block. So make sure that you're checking spot crime and you're checking often before you buy.
Which area of SF is this?
Geez, I don't know. Can anybody, I see Potrero Point to the right. So jutting out of the sea is Potrero Point. So I don't know SF well enough. John Mark, do you know what area this might be? This says Mission District right here. And this says Potrero Hill where all the gunshots are.
Yeah, Potrero Hill.
Okay.
Which actually is a very high rent area.
So Potrero Hill, high rent area and high crime area at the same time. 4 gunshots, all in a 30-day time frame. That's a lot. That's a lot. You don't get that in Chicago.
And compared to South Side Chicago, which has been, nicknamed the murder capital of the U.S.
That's right.
There's almost nothing.
Right. My point is, Chicago deserves its reputation as a murder capital, but that's overall. You're not trying to buy the city of Chicago. You're trying to buy a neighborhood. And in every city, there's great neighborhoods and awful neighborhoods. This is one of the ways to figure out if you're in a great place or in an awful place. All right. So now I've shown you kind of my methodology. The last part that I didn't show you, okay, flashing. Okay, I'll answer a question online in a second here. But what I didn't tell you about, which is kind of a little bit beyond the scope of this presentation, is cap rates. So rather than define cap rates and go into discussions on that, what I would like to say is most people that want to invest, they want to have a 10% or greater cash on cash. I can tell you this categorically, take it from me. If you're going to go invest in a duplex, triplex, quadplex in another city that is not yours, if you're not making at least 11 or 12% cash on cash, do not bother. There's many better investments. Don't bother. Don't do it.
Cash on cash after operating expenses? Or?
Net. Net. You want to have net 12% return. If you're not doing that, why are you bothering? It's harder to do it, right? It's harder to do it. All right, so now, time to get the fight started. Now, the next slide, the first 7 parameters are in there. Please try not to read ahead of me because you won't enjoy it as much. Let me go let me walk you through them. All right, let's take a question first though. Lauren says they're fighting over real estate. I think he's talking about the San Francisco Bay Area. So not a question. That's not a question. That's right. I think he's talking about Potrero Hill. Yeah. I wouldn't be surprised though, right? All right. So let's get started. So here are the 3 cities for our, well, actually, let's start with pictures. I forgot about the pictures. So this is a typical home in Dallas. When you're buying turnkey sort of property, rental property in Dallas, the property was most likely built in the 80s. So the most common inventory in the city of Dallas are 3-bedroom homes that are built in the 80s. They do kind of look old, and the lights are on here, so you can't see as much of it as you probably would if the lights were turned down a little bit. But a kind of a fairly old look is common in Dallas. You won't see a lot of fresh rehabs, and that's both good and bad. Well, that means that some of the stuff in there is going to be old and you're going to have to replace it. But it also means that your tenants are not expecting a fresh rehab in Dallas. They're okay with coming in and seeing old appliances and stuff like that because they know that the landlord holds somewhat of an advantage in Dallas. Dallas is currently at about 3.2% unemployment rate, so people have to take what they can get, right? So it doesn't have to look very fancy. Now, here's the next one, and before you jump on me, I'll tell you exactly what you're looking at. This is Chicago. So Chicago looks, a lot of property in Chicago looks very, very nice. This is actually a standard there. So you see hardwood floors, and you see kitchen cabinetry, and you see the backsplashes. Backsplashes are cheap. They just look very expensive. So they're actually not very expensive at all. The insides are freshly rehabbed in Chicago. Almost all turnkey property looks exactly like this. So I could put another 10 up there and they would all look like this. The outside of the buildings, in my opinion, look ugly for the most part. So this particular building is about by looking at the design, 110, 115 years old. Most turnkey property in Chicago is 100 years old, which is not a bad thing. They keep rehabbing them on the inside, they just don't build them on the outside, because the brick has 200, 300-year life.
Give the brick a break.
Yeah, it's to me, I find it old looking. I hear a lot of people saying they like it. They like the way that they look. And I hear a lot of people saying apartments in the Bay Area are ugly, because all you see is this very kind of, you don't see any texture at all, right? You just see a very flat paint. So a lot of people like these. That's what Kansas City looks like. Kansas City doesn't have a lot of brick for rental homes, so you're going to get frame homes. And the look is older than Dallas. So when you're buying a duplex, triplex, quadplex in Dallas, in Kansas City, it's going to look older than it does in Chicago or in Dallas. There's a very old look that's prevalent there. And you might say, so why don't they update them? Well, the problem is you're not getting rents that are high enough. In Kansas, the rents are much lower than they are in Chicago or in Dallas. So with low rents, rehab doesn't happen very often, right? So people will go 10, 15, even 20 years before they do a round of rehab. All right. So now let's look at these statistics. So Chicago, Dallas, Kansas City. I'm going to go one by one. Feel free to ask questions. Turnkey providers' projected returns. There's a lot of people in these cities that are selling duplexes, triplexes, quadplexes. Dallas, you can even get them brand new. You can buy a brand new quadplex in Dallas for $480,000. And you can even have it built for you if you like that. Now, it's not in Dallas. It tends to be in McKinney, which is kind of the hotbed at this point in time, which is off to the, if you're looking at a map of Dallas, it's off to the right to the top. But it's in a nice corridor. That's, you go past Plano and Richardson on your way to McKinney. So that's actually a growing portion of Dallas. It's in the path to progress. So you can get roughly brand new ones for about $480,000 for 4 units. So the projected returns that you will see when you talk with people there, for Chicago, 16 to 17%. For Dallas, 10 to 11%. For Kansas City, 16 to 20%. Kansas City fluctuates a lot. The reason for that is the homes are so cheap. Often a duplex is going to be $80,000 or $90,000. It's ready for people to move in. The prices are all over the place, so the returns are all over the place. All of these returns are nonsensical. Nobody ever gets them. So the next line is the actual expected cash-on-cash returns that you can expect. This doesn't include principal payback. So as you pay down your mortgage, you're going to get a little bit of a bump there. This also doesn't include any benefits you get from tax write-offs or depreciation. Yes, Holly, question?
Slides that are in alignment with us being able to send these out to people who are interested in having this information.
Yes, so
Private
I don't mind sending them out. I am not selling. I am not a turnkey provider, so I have nothing to sell today. This is something that came out of lots of conversations. I'm happy to send them out to you guys. Do whatever you want.
My announcement when you're done, but
yes.
For everybody in the room that we do have your info.
Yep. So you can only get them if your information is in the damn iPad. So if you put your email in there, you will get this slideshow. So what you truly will get, yeah, go ahead, Rahul, you have a question?
This was your best, this is your kind of projection, right? This is not from another source.
This is my projection based on actually investing in these cities, right? So for example, my biggest investors are here, but my family is invested in Dallas, right? Kansas City, it comes from the turnkey group, so that meets at my house, right? So what I'm really seeing, the returns, the cash-on-cash returns, what does that mean? I pay everything, and then I'm left with something, right? Let's say I bought a home for $200,000, and the total amount of money I put down was $50,000, including down payment and closing costs and all of that. Well, $50,000 is the total cash. And if my return is $6,000 a year, that's 12%. Got it? That's what I'm talking about cash-on-cash return. So Chicago tends to be 12%, sometimes a little lower, about 11%. Dallas tends to be at 7%. This shocks a lot of people. And the reason for that is that everyone expects that Dallas is going to be better than those numbers. I have never found the Dallas pro formas to be reliable. In every case, they leave out leasing fees. In every case, they set maintenance at first-year level. So what happens is, every time a turnkey provider sells you a duplex or a triplex, He's going to fix it up, right? What that means is the first year you will not have a lot of maintenance. Well, what they do is they assume that that's going to be the maintenance for the next 5 or 10 years. It's not, right? It's really easy. You call a property manager that's not affiliated with this turnkey provider and ask them, for this zip code, what is your maintenance? And the standard answer that you will receive is either 7 or 8. What's on the pro forma? 3 or 4. Obviously, those numbers are wrong, right? So now expected annual appreciation, my best guess, and this is very controversial, right? Because a lot of people don't agree with these, and I'll give you my thoughts on them. So Dallas is easily going to be the best appreciating, and even that 5% number is low. The only reason I leave it at 5 is because historically Dallas hasn't appreciated well except for the last 4 years. So we've had great appreciation over the last 4 years, but if you look at the 20 years before that, it really hasn't gone up much, right? Dallas is really cheap. Well, the answer is because I believe that Dallas has now reached a turning point where it becomes a powerhouse city. And it's now attracting inward immigration from 47 states, which is why I believe that the rents will keep going up faster, right? And keep in mind, I know people say they have land, they have endless land. Yes, but nobody wants to drive more than an hour. So people will compete and will pay more for a house that's, in Dallas, it's still only $25,000 more to get a 10-mile bump. Why wouldn't you pay it, right? It's still very reasonable. So Chicago annual appreciation at 3% is also higher than the past. Chicago has not appreciated at 3% in the past. The only reason I put 3% in is Chicago is in an affordable housing trap, okay? And about 15 years ago, the US government stopped financing affordable buildings. So we used to have this program where people would build these affordable houses and we'd give them lots of subsidies to build them and subsidies for rent. Well, we stopped paying that right around the 2000 crash. And after that, what's happened in Chicago is that material costs have gone up a lot. And now when you build in Chicago, you can't really sell it for less than $150,000 per door. But there's inventory in the marketplace at $70,000 a door. So all the builders are only building either in the city or in some affluent portions of the north side. So what's happening is the rest of the city has completely dead inventory. There's no increase in inventory, but there's an increase in population, right? And you might say, well, builders should build more. Well, they can't because they can't sell them at $150,000, but that's what the price in the market should be. So over time, Chicago has to appreciate faster for eventually for rents to catch up with the building price. It's going to happen. It's just the laws of math. So eventually Chicago will appreciate faster than the past. In the past, the city has appreciated at somewhere around 1.5 to 2%. So those are my numbers. Kansas City is in a similar trap, but not quite as bad as Chicago. They still have some room. Yep.
What's your thoughts on other parts of Texas, like Houston?
Okay, let me repeat the question. What are your thoughts on other parts of Texas, for example, Houston? The answer is Houston is kind of in the 8th inning, if you want to use a baseball analogy. So I would not go there. Now, a lot of people say Dallas is in the 8th inning, and I want to remind them that right now, after all of the price increases in Dallas, you can still buy a 3,600 square foot home for $320,000. My sister, who just moved to Dallas, bought one of those homes, $320,000, 3,600 square feet. How can this place be out of whack? They're not out of whack. They're cheap, and they will continue to be cheap. So what will happen is, yes, Dallas is in the 7th or 8th inning. They'll go through the 9th inning. Then they'll flatten out. I don't expect that flattening to take more than a year, and then they're going to have another 9 innings because it's possible. The people in Dallas make good money. The average salaries in a lot of places are over $80,000 per household. Well, if you have $80,000 per household salaries, and an average home that's 20 years old is still under $200,000, there's a lot of room for it to go up. And the city is creating insanely large numbers of jobs.
And what about with Texas? Property tax is a whole lot higher.
Okay,
How does that affect your calculation?
so the question is, how do Texas's high property taxes affect calculations? The answer is they don't. Californians think we have the lowest property taxes. We are all delusional. California has the highest property taxes. That's because our homes on average cost 3 times as much. Okay, so neither Texas nor, so my sister, she has the same home size as me. I live in a 3,400 square foot home. I pay $15,500 in taxes every year. She pays $6,000. Whose taxes are more?
But I thought you've already considered them in the cash on cash return.
I have. The taxes, Texas's or Dallas's taxes are already in the 7% return. For people that are interested, I have spreadsheets, and they're plugged in there. Dallas's taxes are 2.5%. California's are 1.2%, somewhere in that range. But in terms of dollars, not percentages, California always beats Dallas. They don't have high taxation, they have low taxation. All right, so let's move on. So the last one is total annualized return. Chicago at 15, I would say maybe 14. So I'm being a little generous to Chicago. I'd say 15, 14. Dallas is going to be 12 to 13, except if what I hold, what my theory is that it's true that they're about to go through another baseball in 9 innings of baseball, where essentially where they're going to finish this round, flatten, and go through another one. If that happens, they'll get more. Dallas could get more. Now, one challenge is at some point they can always build more, right? They've got more space. Unlike Chicago, they're not constrained by the lake on one side. They can build in all 4 directions. Kansas City, 13, and being a little bit generous there, and I'll tell you why in a few minutes. So then the next one, the next parameter is for those people that do not want to buy and hold. There's a bunch of people that just want to flip, right? They want to do rehab projects, and they're just sick and tired of the Bay Area not having the sort of returns that it had 2 years ago. 2 years ago, Bay Area was the best rehab place in the US. I mean, it was amazing. People made incredible amounts of cash. There are still some people that are very competent and that continue to make cash. But for folks that are really not into niche markets, it's very difficult to make money in the Bay Area as a rehabber now, right? So for those people that are looking, well, these are the typical kind of returns that you get. Chicago very consistently and very easily gives you 40K for a duplex. And the inventory of duplexes, there are 25,000 available duplexes in the city of Chicago to choose from. It's a staggering number, also very true. Dallas, your challenge is not the money. You'll still make 30K because it's a hot market and it'll sell very easily. It's going to sell very quickly. You're going to sell it in 30 days or less. The challenge is that deals are getting harder to find in the city of Dallas. If you go to Fort Worth, you still might find them and make 30K. So it's not a bad market at all. Kansas City, the challenge is selling time. So you're probably going to make a little bit more if you have a source of buyers, but I've heard of properties sitting on the market for 180 days in Kansas. So that's the challenge, especially triplexes and quads. Duplexes might be easier in Kansas. So returns for private lending to rehabbers. So here's another audience. We've got a bunch of people, maybe in this room. Holly, for example, dabbles with private lending. So there's people that want to do private lending, right? But in the Bay Area, if you've been involved in private lending, you know what's happened. The returns have been hammered down. Yeah, it's a little crazy market. To be honest, I echo that. I think the Bay Area has become a risky market to lend in because no market can keep going up forever, right? So if I was a private lender, I'd be looking elsewhere. Where do I lend? I lend very consistently. I lend in Chicago and I lend for duplexes, okay? And the math on them is very simple. $40,000 purchase price, $80,000 rehab, $175,000 sale price. Okay, and rinse, repeat, don't do anything else. You can do it all day and all night in Chicago. So those are the sort of returns that you'll see there, 12%, maybe a little bit higher. Chicago does have some people that will give you more money. I'm not sure what the quality of the rehabbers is. Dallas, 11%, KC, 11%, Bay Area, 10, 9 these days in the Bay Area, which is a ridiculously low amount of money for a hard money or lending project, but it is what it is. That's just the way that the Bay Area market's working. Eviction process. So Chicago is not friendly to landlords and takes 90 days to evict people. It takes 120 days if you're evicting people in the 4th quarter of the year because they won't kick them out when it's very cold. right? So they have the judges there are humane. They won't kick him out if the temperatures are very low. Dallas is fantastically easy. Dallas is incredible for kicking people out. They're very friendly. They actually allow you to break down doors, which is very rare. Most states will not allow you to do that, but they allow it under certain conditions. Kansas City is somewhere in the middle, so it takes about 45 days to evict people. All right. Price per unit. So in Chicago, a fully rehabbed duplex is probably going to run you 160 to 170,000. A triplex 250, and a quadplex 300, somewhere in that range, 310. Would you say that's accurate, Charles? 310, 320 for quadplexes, maybe a little more.
Yeah, it's all right.
So about right. Okay. So in that range, Kansas City is cheap. You can get stuff that's ready to move in at 40,000, 45,000 per unit. So you can get quadplexes that are 160, 170,000. Dallas, again, 70K to 80K per unit is fairly standard. You can get something cheaper in Fort Worth. Fort Worth is about $70,000 a unit, and Fort Worth has tons of duplexes and a lot of triplexes as well. Delinquency, Dallas, so Chicago is higher, which again, obviously the returns in Chicago are higher, but the pain is higher. So you kind of start seeing there's more pain on the Chicago side and lower pain on the Dallas side, but then you're getting a lower return there. So I'd say medium high, in some areas very high. And Dallas is medium low. Why? Because they know that they can be kicked out in 30 days, so they tend to behave better, right? Kansas City has a significant delinquency problem. I have friend after friend who's told me they go into KC and they don't get the returns that are projected because they're turning over tenants every 9 months. So you really want to turn tenants over every 18 months to 2 years. 2 years is kind of hard. Every 18 months is okay. Volume of 2 to 4 unit properties available that you can buy. Chicago is really easy. Dallas is fairly easy at this price, maybe at the 75K price, you can find a lot of them. It's a big city, millions of people. There's a lot of inventory. They're not hard to find. And you can also find a lot of turnkey providers that will sell you duplexes and quadplexes. Also, Dallas, unlike Chicago, is doing new construction, but they're at 120,000. That's the standard price in Dallas, $120,000 a unit. You can buy quadplexes all day. KC has a small amount of inventory. Now, it's not that you can't find them, it's just not ready inventory. You'd have to talk to a number of agents in KC and spread the word that you're not looking for single family, you're looking for duplex, triplex, quadplex. The inventory will come. It's not too hard. Question? Someone had a question? Yeah.
So this one is almost showing like Chicago must have a higher rent because it has a higher per unit price, but that's not what you're implying, right? Because
no, I am implying that Chicago has higher. Well, the key is that Chicago does have slightly higher prices than Dallas, yes. So, but then what ends up happening is because of higher delinquency, you lose some of that margin. But in the end, you're still making 12% in Chicago versus 7% in Dallas, right?
so the per unit rent would be $1,000 plus, it seems like.
So most of the duplexes or triplexes that you're buying in Chicago that were built 100 years ago were 3 bedrooms. So I'd say 90% of the available inventory is 3 bedroom. Now, keep in mind, I am mixing things a little bit because the 3 bed, in the first column, these are all 3 beds. In the second column, these are a mix of 2 bed and 3 beds. Dallas has mixed inventory. Chicago's all 3 beds. So price competition amongst buyers is low. Chicago has not recovered 100% from the recession. There's still foreclosure inventory. So if you go on Zillow, you might start seeing homes, 3-bedroom duplexes, that's 6 total bedrooms, selling for $40,000. Now, they're not rent, you obviously have to spend $100,000 on rehabbing them, but that kind of inventory is available. Dallas had foreclosure inventory until the beginning of this year. Now doesn't have much. There's very little. If you go to Fort Worth, there's still some foreclosure inventory. Fort Worth, for those who don't know, is a sister city of Dallas. KC has absolutely no price competition at this point. They have very significant foreclosures. They're still working on a large amount of foreclosures, so you can buy them extremely easily. You can buy 10 properties in a week if you like. So long-term rent growth. This is not the same thing as appreciation, right? I gave you appreciation numbers before. These are long-term rent growth numbers. Chicago, I don't feel is going to grow faster than 2%. Yes, I saw that 6% number from Marcus and Millichap. I think that number will apply for 2015 and will again apply for 2016 because they're in that affordable housing trap. But I think at some point it'll equalize back down to 2%. Last 12 months have been phenomenal, but to be honest, the last 12 months have been phenomenal for every state in the union. They just have been incredible. The entire multifamily market is on fire and continues to be on fire, by the way, has shown absolutely no signs of slowing down at all. Dallas, I think, could be 3%. It could be higher. Again, with Dallas, there are a lot of intangibles that could make Dallas the new California, or I should say the new San Francisco Bay Area over the next 2 decades. You could see higher returns if you have patience, because you don't really know when it's going to go supernova again. It's been insane for the last 2.5, 3 years, but it might just sit there for the next 3 or 4 years, or it might take off for another round. So you've got to be very patient with Dallas if you're looking for the higher rent growth and the higher appreciation growth. So with Chicago, you get the money every day, right? So you get a certain amount of money, 10, 12%, whatever it is, and you get it all the time. But with Dallas, you have to wait. It's one of the waiting games things where over time you might make more money, but over time could be 3 years, 5 years, or 7 years. Property management quality. So from what I've seen, Dallas has the best property management quality. Not because it's Dallas. It's simply because their laws are better. So it's not that the property managers are better. It's just the laws are better. So if you have the law on your side as a property manager, aren't you a little more aggressive with your tenants? Because you know that they have less power, right? So they tend to be more aggressive. In Chicago, there's more give. But they're decent. And there's a high volume of property managers available in Chicago. I've fired 2 of them in the 2.5 years that I've been there. But the third guy that I found is the best. I'm really happy with him. But if I had to fire him, I could find another one in a day. The problem with KC is that the property management quality is poor because the revenue is very poor. You're only making $500 to $600 in rent. But it takes the same amount of time for that property manager to manage a $500 unit as it takes to manage an $1,150 unit in Chicago, right? So obviously they have to cut corners somewhere with their time, and as a result, the quality of property management in Kansas City is very poor. Average tenants occupancy length, I would say Chicago is a little lower than 2 years. It's maybe 20 months, 21 months. Certain areas even lower, but generally about 21 months. Over my 22 units, I've been at about 19 or maybe 18 months, but some of that was inherited. I inherited bad units and I knew I was getting a big discount, so I had to evict some people, and the newer tenants are definitely higher quality. KC, again, has at least the eviction process is not very long, but you're going to probably turn over people every 18 months. Now, jobs added by Metro is a very, you can't compare these jobs. So 55,000 is 1% growth for Chicago. For Dallas, it's about 3% growth, so that's a phenomenally high number. Dallas produces an insanely large number of jobs and has been for the last 3 years. Kansas City, that's still around 1%. It's a smaller metro, so it's not quite 1%. It's a little bit less than 1%. Now, I have to tell you, Kansas City has surprised me in terms of rent growth. KCMO's rent growth last year was 10%. Now, it is an outlier in my opinion, and it will return back to the 2% growth because the city isn't growing very fast. It's not adding a lot of jobs. But I guess what happens eventually is cities that are very cheap eventually just run out of housing, and nobody's built new houses, because when you have all these $50,000 houses, how can you build at $150,000 a unit? Nobody will buy, right? So at some point the rents have to bump up, and it happened for KC last year. Chicago is forecasting 6%, which is another one of these crazy bumps. But I'm not sure if they're sustainable sort of bumps. Questions? Does this make sense? Yes? Any more? No? Okay, all right. All right, so let me give you the bottom line, who wins? Because there's really categories and there's no clear winner, but there are winners in categories. So appreciation, right? I think by now it's obvious. Dallas wins easily if you're appreciation focused. Long-term hold, Dallas wins for a much longer hold. What I mean by that is over 6 years, because I think this metro has long-term potential, but don't look at it if you want to invest for 5 years. You don't know if it's going to happen. There have been times in the 80s and 90s where Dallas had zero appreciation. Nothing, absolutely nothing at all, not even inflation. So you don't know when the next round's going to be. So you have to be a very patient investor if you want long-term hold for Dallas. But I believe that if you held for 10 years in Dallas, yeah, you'd win. Cash flow, yeah, that's a really easy one again. If you're a cash flow investor, and there's nothing wrong with being a cash flow investor. I know that a lot of people feel that cash flow investment is bad. Please understand that the rest of the world doesn't think that. That is a California attitude. In California, people invest for appreciation. The rest of the world mostly invests for cash flow, rental income. So there's nothing bad about that. Chicago is a clear winner there. It's the only one of the three that you can get to 10% or more net income. Private lending and rehab. Private lending is more profitable in Chicago, much greater volume. So you're going to get, let's say you have $1 million to invest, you can probably invest all of it in Chicago within a quarter in good projects. The challenge with Dallas, you're going to have trouble finding rehabbers. It's a very competitive market right now.
Question?
Yeah, Neer, yeah.
Rehabs in the winter in Chicago?
Rehabs, so very good question. So the question is, what about rehab in the winter in Chicago? The best thing that you can do as a private lender is invest in Chicago in February and in June. So that way, you get a Feb, March, April, May, so 4-month project. You do your flip and then you do June. Then that's June, July, August, September, maybe October, maybe even November, because Chicago isn't very cold until about November 15th. So your flip will go through and finish. Do not invest in the winter. It can get stuck. It can get stuck. So yes, it's doable, but that's a very good question. Scalability, if you're looking for scale, Chicago's better. So a lot of people are like, I have $1 million to invest. Well, good luck trying to do that in Dallas, because it'll take you a year just to get your money productive, right? From a scale perspective, Dallas works better. I'm sorry, Chicago works better. So what about Kansas, right? So it seems like the city comes in second or third on everything. Unfortunately, that is what it is for the moment. It cash flows well, but there's delinquency problems and there's illiquidity. What do I mean by illiquidity? Well, it often takes 6 months to sell, right? So that is a problem. KC stuck in a low growth rut, so they're under 1% in terms of growth. So rent growth could also reduce over time. Now, having said that, there is a caveat for KC, and I know there are some people here that are going to like this last part. If Fight Club was for single family, there is a strong chance that Kansas City would win. There are perfectly serviceable single family homes that you can buy for $40,000 and not even bother with a mortgage. So there is a market there. It's a very tough to manage market, but there's money there. You're taking on a lot of pain, but there is a market there. You might have trouble finding mortgages for those. So KC investors, what they do is they actually buy 7 or 8 of these homes, and they put them in a portfolio, and they get a single portfolio loan for those 7 or 8 homes. You have to do that, otherwise the leverage piece of it doesn't work at all. So it's more of an advanced technique, but it does work in Kansas City. All right, so if you find this interesting and there's people amongst you that actually want to go out and do this, go buy homes in Dallas, homes in Chicago, homes in Kansas City. I'll give you some next steps, but first I'm going to give you some information. This is a shameless commercial break plug about my 237 unit project. So I want to quickly give you a little bit, and I know most of you have heard about this, so I'll give it to you very quickly. Jean-Marc, Holly, and I are buying a $12.1 million, $12.375 million building. It's actually 6 buildings, and there's 3 pictures on the right. Those are 3 of the buildings. This is a cash flowing property. We expect 23+% returns over a 5-year time frame. We have a number of investors in this room. I think we have 4 or 5 investors that are in the room. We've taken over 181 of the 237 units and are moving in new tenants. Initial rent estimates actually appear to be conservative. Our pro forma appears to be conservative, so the team's happy about that. Property management team is hired, is already on site. If you're interested, this is a good URL to go to. You can watch videos. You can read a lot of interesting documents about the property. The only other thing that I would say is our timing appears to be very good. UBS, which is one of the largest banks in the world, they had a new report that came out last month. It shows Chicago is the only undervalued city in the world's top 15 cities.
Neil, do you have time to play the video for those who have not invested?
Well, the challenge is I've got a huge number of people online and they can't watch the video.
Okay.
So that's why I'll play it after I'm completely done and I've ended the webinar. So keep in mind that this URL that you just saw at the bottom has the video. That link that you saw at the bottom. Bloomberg just wrote an article, this came out about 4 weeks ago, about significant rent hikes in multiple cities because subsidized housing is switching to market in 2017. And the highlighted neighborhood of all the neighborhoods in the dozen cities that they were talking about happened to be South Shore. Yay! That's the neighborhood that we're in. And Marcus and Millichap, which is my favorite brokerage house for commercial, these guys are absolutely awesome. They must have dozens and dozens of people doing research. They raised their estimate of Chicago, and you saw that earlier in my presentation. Rent increases went from 3.3 to 6%. Our underwriting, I think, is based on 2%, right? It's just 5% for the first year because we are under market, but then after that, it's all 2%. So we're really happy about that. I think this is a great property, a great time. Now, where are we? We have now completed 90% of our fundraising. We have a few shares left. So we have a number of people interested. If you are interested, then this is a quick move process. It's not something that's going to go into December.
You guys
So
take note that address is where the video is.
that's right. And a lot of other content is on there, financial-attunement.com/next.
For anybody online.
And I'll also shoot you this link later. So that's about Chicago. Done with the commercial break. So here are the next steps. Very quickly, if you're interested, this is the stuff you need to write down. Do your homework. Search Google for turnkey real estate and then followed by your city name. Talk to those people, but for God's sake, don't trust the profit and cash flow numbers. They're always wrong. I'm actually yet to find a single turnkey provider that's honest. They all lie because it's normal in their marketplace for people to lie. So everybody does the same thing. And the lies are really almost always in just 2 lines. The vacancy and the maintenance. So those 2 are almost always wrong. The third one that's hidden, which is there isn't a line for it, is leasing cost. So there's a cost for leasing your apartment. Everybody assumes that this cost doesn't exist. Discuss the numbers with a knowledgeable real estate mentor. So if you're going at Chicago, you might actually want to go to a meetup group in Chicago. You cannot buy in another city without visiting it. That's a capital mistake. When you go there, make sure you're going there on days that there are meetup groups there. Go talk to some of those people. So if you happen to be part of my group, you're welcome to come talk with me, but I have limited knowledge of these cities. Then decide what type of investment you're interested in. Some people want to invest passively in large multifamily. If that's interesting to you, I'm your man. If you want to buy your own 2 or 3 or 4 unit, keep in mind it's a lot of work. So you might get very decent profits, but it's a lot of work. So sign up for that amount of work as well. Do you want to rehab or you want to buy a stable unit? You're going to have a copy of my presentation. So go back and look at, does rehab work well for Chicago? Does it work well for Dallas? Do you want to lend your money? So, I showed you whether Chicago is better for that or Dallas is better or Kansas City is better. And then think about where the money will come from. For large multifamily, it almost always has to come from you because that's just a plain investment, right? So you're buying a partial share. Many people can afford to buy their own 2 and 3 or 4 unit by buying from a turnkey provider or by buying directly from the market. So you can actually be the sole owner, which I can tell you from experience is both good and bad. Rehab projects require both money to buy and money to rehab. For people that have done rehabbing locally, rule of thumb is this: it will take you 3 times the amount of time to rehab remotely as it does to do it locally. It takes 3 times the amount of time. Now, it might take exactly the same amount of time. In that case, 100% of the time you will screw it up. So if you're not willing to put in that 3x time, it's not going to work. You can also raise money from others and buy and rehab and lend. Obviously, raising money for a smaller project can be actually more challenging than raising money for a larger project, so know whether that's something that you can do. But there are several people in the room that have raised money for small projects.
And who are they?
I'm not gonna mention.
Yeah,
So
you have to.
for large multifamily, there's no time investment, right? 2, 3, 4 units, a lot of time when you're buying. Rehab, very profitable, a lot of time, and lending, you typically don't need visits if you have good property inspectors. So I can tell you Chicago has good property inspectors. Charles and I use the same guy, and I trust that guy implicitly. I think he's very, very good. So the larger cities have good people, but you have to find good property inspectors. In general, I can tell you a property inspector will always do a better job of inspecting a property than you will. Most people give themselves too high of a rating as inspectors. We tend to miss the stuff that hurts the most. So it doesn't matter if you go to the city, take a property inspector with you. So I think the 6th one is really, what's your approach? Fix and flip, buy and hold, future appreciation, large multifamily, lending. What's your approach? Think about that. A lot of people start out, but they don't really compare the approaches in terms of time and money. So I'm repeating, I know this is repetitive, but I'm trying to tell you, think about your approach at the beginning. Don't jump into something because you might not be able to sell it if you don't like it. If you want me to introduce you to turnkey providers or fix and flip companies or rehabbers that need a private lender, send me an email and I will introduce you. To me, and I'm very honest in saying this, I think multifamily passive is a better investment if you have a full-time job, and I'll say that all day long, but some people just want to do it their own way, and I'm happy to introduce you to people that have helped me. Questions? Does this make sense? Online, usually what happens is I get no questions online for about 2 minutes, and then all of a sudden I get 20 of them. So folks online, this is also your turn to ask questions. Let me go here so I can actually see they're asking questions. I only have 17. Oh, I had less attendees than I thought. This makes sense? Anybody thinking about making these kinds of investments on their own or with raising money for them? No? There we go. It took a second for hands to go up. That's good. That's good. So I think that you guys should definitely be talking with me a little bit more, and I'll kind of point you in the right direction. All right? Yes.
So I'm wondering if you're thinking of a particular formula. You said in Chicago, there's 60,000 jobs that are created. That's about 20,000 households.
Yes.
So in general, do you just kind of think it's a third?
I would say you would need 20,000 units so that there isn't a long-term supply-demand imbalance. Let me repeat the question though for the online folks. So what's the formula? If a city produces 60,000 jobs, how many apartment complexes should it, or apartment units should it produce? The real answer in my mind is about a fifth, and I'll tell you why. So if it produces 60,000 jobs, it should produce about 12,000 units, because even though there are families of 3, some of those families, multiple people with jobs can live in the same unit, right? So you can have 2 people or 3 people with jobs. So if Chicago is producing 12,000 units a year, there wouldn't be a supply-demand imbalance, and you'd never see a 6% rent increase, right? Marcus and Millichap is saying it's going to be 6%, and they're saying it at the end of October. So obviously they're looking at the first 9 months when they're making a prediction. So it's going to be very close. They might be off by, fifth of a point, but they're not going to be off by 1 or 2 points at this point. So I would say rule of thumb, use 1 in 5. If it's not producing 12,000 units and producing 60,000 jobs, there's a lot of opportunity. Online question, let me take that.
So actually, I wanted to add to that, but I want to get close enough to you that
Sure,
you can hear.
there you go.
So typically when jobs are created, if a company creates 1,000 jobs, those families move in, they need 1,000 units, and they're also going to create other jobs because new people in the neighborhood are going to need new restaurants, new support staff, etc. So the rule of thumb is actually 1,000 jobs really creates 3,000 to 4,000 jobs. So when 60,000 jobs are being created in the marketplace, you actually have more than that moving in. One of the things in Chicago, there was a fair amount of vacancy from years past when the Chicago used to be a more populated city. So even with the brand new units, you're still going to be rehabbing old units. So you may have 6,500 new ones, but they're also rehabbing old ones, and that's going to limit some of the upside.
That's true.
So, just to clarify, Chicago used to have 3 million people, now they have 2.7, but that 3 million was in the 50s, so in the 1950s. So there's still some old inventory. It's not inventory that's readily available. There are homes that have to be fully rehabbed. So as rents start rising faster, the rehabbing activity in places like Chicago increases. So I have a question online from Bruce Gladstone. What's a fix and flip company in Chicago, for example? The answer is, Bruce, please send me an email. So the answer is, at this point, I want to go back and look at my list of companies. So send me an email and I'll send you one. Question from Homayar Gandhi. Hi, Neil. Do you find/line up lenders before identifying a multifamily property or after? So I'm going to address that question specifically for small multifamily. When you buy a small multifamily of 4 units or less, it's based on your credit, correct? You're buying based on your credit, or if somebody's partnering with you, you're buying based on their credit. So they should already know if they're going to qualify, and you do that by getting a pre-qual form that's roughly equal to the amount that you're buying. So if you're buying a triplex and it's a $220,000 triplex, whoever's going to be on the loan needs to go out and get a pre-qualification form, and you're going to need it anyway, because when you make an offer, they're going to expect a pre-qual form to be attached to it. So if you are not pre-qualified, the seller is not going to give you much time. Hopefully that answers the question. Homayar says, what about 10 to 50 units? The answer is, when I'm looking at 10 to 50 units, I don't line up lending before. I don't. I make an offer and then go find a lender, because the challenge is, once you make an offer, you're going to go in and do some due diligence. It's going to take some time for the seller to actually give you the documents. Sometimes it takes months, right? John Mark's seen this. Sometimes it'll take them months to really give you all the documents. Well, you need those documents to file for your loan, right, to get that information. So, lining up a lender before may not necessarily work.
But even though you don't have a specific lender lined up, you should know the guidelines going in. So when you're buying, say a 50 units, if let's say it's going to be $1 million purchase and you need an $800,000 loan, you need a net worth of $800,000 and post-closing liquidity of about $80,000. So after you put the down payment in there. So even though you don't have a specific lender, when you're going in, you want to know that it's financeable. So if you're going in and buying a property that's not stabilized, let's say it's 50% vacant, if you don't have a lender that will address that and you don't know where to go for that, you shouldn't be making an offer on that. So it's you do need some sense of where you're going with it. Otherwise, don't make the offer.
Also, let them know when you come to money that you raise the capital for them once it's structured safely.
So Holly is pointing out another issue. When you're buying a larger property, if you don't have the down payment yourself, you need to go out and raise the down payment as equity. So that's part of a syndication process. So that's a whole other thing. We've been talking about small multifamily, but when you talk about large multifamily, you need to have a network of investors that you can go to. When you're ready to buy that property, are going to come in with you.
So when you say large, it even true for 8 or 16 units that are many times available as, let's say, 4 buildings together or 2 buildings together?
So the question is whether the large applies to 8 or 16 units. You know, large and small depends on the markets. In San Francisco, if you buy 8 units at $500,000 a piece, you're at $4 million property. In Dallas, you might buy 200 units for $4 million. So again, it depends on what your resources are. If you have $2 million sitting in the bank, then you're great. If you have $50 sitting in the bank, you need investors with you.
Yeah, I guess my question was, you mentioned something like similar amount of assets as you purchase, so to convince them and other stuff. So you were giving some rules of thumb.
Okay, so rules of thumb, just in terms of the purchase, anything 5 units and above is considered commercial. 2 to 4 is single family residential. It's residential real estate, and there are 2 different sets of lending. So your typical residential mortgage broker can help you on the 1 to 4s, and then 5 and above is a whole different kettle of fish. So 5 and above, the rule of thumb basically is net worth equal to or greater than the loan that you're seeking. And you want liquidity after closing. So after you put your portion of the down payment in, you still have to have at least 10% of the loan amount liquid. The other piece to that is your resume. What have you done? So if you only ever owned your own home and you're buying a 200 units in some other state, you're probably not going to qualify. We build our business buying mismanaged real estate. And the 181 unit that we're buying in Chicago, 43% of the guys' rents are delinquent. It's really sad. He's done his best. He just doesn't know how to do it, and he's not willing to hire professional management. He thinks he can do a better job. So the lenders are looking for that. They want to know that you have experience doing what you're doing, and they won't make the loan if you don't.
Does your acquisition strategy include seller financing and try to see if you can provide that for you?
Yes, we actually have a letter of interest out right now on a property in Dallas, 200 plus units. 200 plus, where the seller is willing to carry the entire financing, which makes it. We had another property in Dallas. Our lender, I won't mention names, but took 7.5 months to close, and I was ready to shoot someone's head off. Those 7.5 months saw the property do exactly what we expected. The income went from 110,000 to 123, so it wasn't a bad wait. But with seller financing, obviously you can close a whole lot faster.
All right, so we're about 20 minutes over, so we're going to close the online session at this point. So we'll take that as the last question. Thank you for attending, and people in the room, time for networking. Let's close this.